Woohoo! Kiwis have reached a KiwiSaver milestone.
This year, the good news is we've cracked the $100 billion mark.
That's the boffins at the Financial Markets Authority releasing the good news. But is it really that good? Well, not compared to Australia's savings pool.
It's now 4 trillion, which is about 40 times the size of our size.
Yes, they started earlier, but there's another difference. Investing in private equity for better returns, potentially. So why don't funds here dive into it?
They don't want to be associated with having invested in a failing business.
But does that mean KiwiSaver managers are selling Kiwis short by being risk averse? Welcome to the NBR Podcast. I'm your host, Simon Shepherd. Head onto YouTube and everyone has a bit of advice about your
KiwiSaver.
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 KiwiSaver. KiwiSaver savings.
It's only been going 17 years, but is now the time for this blossoming financial teenager to mature into some different investing? That seems to be what Commerce Minister Andrew Bailey wants. Ease up on the foreign shares and bonds and invest in Kiwi businesses. Well, some KiwiSaver funds are doing it already, a little bit. In this episode, we talk to provider Fisher Funds, which is making a play in that sector, and startup fund Movac about the risks and returns of investing in early-stage companies. But first, how does our $110 billion KiwiSaver sector compare to other countries' retirement savings schemes?
I think it's significant in New Zealand context relative to what we had 15 years ago, which was essentially a very, very small retirement system.
Greg Bunkle is Director of Managed Investment Data for financial research company Morningstar.
But compared to other markets, both at an aggregate level and a per person level or a percentage of GDP, it's still relatively small.
Right. So
it's about 4% of our GDP. In Australia, the US, the UK is it's more than double that as a kind of a percentage of GDP.
Okay. And our per capita savings in KiwiSaver are quite small as a result.
Exactly, yeah. We just started a lot later than a lot of those countries, and they have higher minimum sort of contributions required and things like that. To give you some context, in 1992, Australian superannuation was 150 billion.
In 1992.
Yeah, and it's now 4 trillion, which is about 40 times the size of our size. There's about 8 funds in Australia, 8 super funds in Australia that are bigger than the entire KiwiSaver.
And they're all got more than 100 billion under management.
Yeah, we're around that. Yeah.
Okay.
Yeah. Some have got $250 billion in themselves.
Okay. All right. But seeing as KiwiSaver is growing and it's now over that 100 billion mark, first of all, where does the bulk of that 100 billion reside? When fund managers, when you look at them, where do they invest?
So they predominantly invest in a sort of a diversified offering of New Zealand shares, Australian shares, international shares, and domestic and international bonds. That's primarily where New Zealand KiwiSaver money goes, which there is a slight divergence that we see in other markets, but that for New Zealand, that's predominantly where the money goes.
There are 3.3 million people enrolled in KiwiSaver funds, although a third are not contributing. And until recently, the literal default position has been risk averse. The 7 default funds were conservative.
Our KiwiSaver plans are immature, according to international experts.
But that changed last year.
The asset allocation of the default funds is going to change to a more balanced mix, so typically 60% in shares, 40% in bonds and cash. So that'll mean for those people that actually don't make a choice, they're in a better mix and a better balance of investment.
How has the appetite for risk changed over the years from KiwiSaver members?
Yeah, I think as time's gone by, KiwiSaver members have got used to risk.
Ashley Gardine is the Chief Investment Officer for one of the largest KiwiSaver providers, Fisher Funds.
KiwiSaver first set up just before the global financial crisis, so we had a pretty big downturn right at the start of the scheme. Since then, they've been through the GFC, the pandemic, a bout of inflation quite recently, and I think people have usually got used to the experience that there can be volatility, but still long-term the results can be pretty good despite that.
Did we see an acknowledgement of that changing appetite for risk with the government changing default funds from like conservative to balance? Is that a recognition of that?
Yeah, absolutely. I think there's a long-term recognition that KiwiSaver is a long-term scheme and you need your assets to grow over and above inflation. Conservative funds may not do that appropriately, whereas a balanced fund should certainly do that, and a growth fund would achieve even more.
But Fisher funds and other players want to go even more into other asset classes, alternative classes, and they're known as private equity and venture capital. Can you just give me a rundown of what they actually are?
Yeah, so the whole spectrum, I guess, in KiwiSaver would go from cash to fixed income and equities, and they're all sort of public market investments, whereas private equity is, as the word implies, private. So these are buying not listed companies but private companies. Now that's been a real trend, globally for decades now, and in Australia or the US, pension schemes will usually have quite a big allocation to private equity, but it's a lot newer here. We have a handful of private equity funds, but even the private equity industry in New Zealand is reasonably new. And what these firms are essentially trying to do is buy private companies, grow them, and then exit them 3 to 5 years later for a profit.
That's the investment arena the government is looking at. It's instructed officials at the Ministry of Business, Innovation and Employment to look at what's stopping KiwiSaver funds investing in private assets. And when you look at the numbers, New Zealand has only dipped its toe into the private equity waters. Here's Greg Bunkle from Morningstar again.
It's all very immaterial.
What do you mean immaterial? What do you mean by that?
So, we've got about 1.8% of total KiwiSaver assets that are invested in what we would call private, alternative, private equity assets, infrastructure, non-listed shares, not bonds, right?
Okay.
In Australia, that number's just under 20%.
20%.
Yeah, and I would say as well, the bank KiwiSaver funds have got no exposure to anything at all. They're just very vanilla, passive type offerings, very much just listed shares, listed bonds.
But is there more reward? Is there more chance of a higher return from these kinds of assets? Is it something that you see could be an avenue for these KiwiSaver funds managers?
Morningstar's done a lot of work in modelling on this over the years, and the work that we have done has shown that it can bring benefit, but that's not been stress tested or peer reviewed. The literature on the inclusion of private equity, alternative assets in retirement savings is limited.
Right.
So it's not just a given that they should be included. It's an open discussion. There's two sides to the argument.
One way KiwiSaver funds can invest indirectly into these early stage companies is via another fund, which itself tries to pick the long-term winners. And one such fund is Movac.
Yeah, I'll give you the elevator pitch. So Movac is a technology investor based out of New Zealand who primarily invests in New Zealand-based technology companies, taking really interesting products to the world.
This is one of Movac's partners, Jason Graham. Give me some high-profile examples of where you have invested and exited.
Yeah, absolutely. So I think Power by Proxy and Fatty Mashriki's journey there was one that we were part of from beginning to end.
Power by Proxy and its wireless charging technology was reported to have been sold for somewhere between $100 and $270 million. And what happened to that company?
So it was bought by Apple.
Right.
For,
okay.
A large publicly disclosed number, which I can't say is correct or not. But it was a great journey. And, we invested in Fatty and his co-founder straight out of university in their very first round. And we were in that company for 12 years.
Okay. This kind of investing has the reputation of being risky. So startup companies sometimes they go belly up, right? They don't always make it through. Do you guys have a hit rate in terms of you choose a certain number and how many, a percentage of that you actually get to exit from?
Yeah, so there's a few ways to think about it. If you take, say, investing in 10 early stage companies, your classical venture investor thesis would say that 5 or 6 of those are going to be zero.
Mm-hmm.
1 to 3 might be some kind of return, and then maybe 1 will hit it out of the park.
Okay.
And that's what we saw in Fund 2, where we had 2 hit it out of the park. There was Aroa Biosurgery and Power by Proxy out of 14 investments.
Right.
And that thesis kind of played out exactly like that.
Yeah.
Now, one thing this does touch on is failure is expected, and that's not something that I think the New Zealand psyche is particularly attuned to. But absolutely, when you go into a company, you have to understand, and the founder has to understand, actually the most likely thing here is this will not work. And there's nothing wrong with that. That they can, founders can gain a bunch of experience and go on to do the next thing and kind of compound on that, even if their last business didn't go well. We in New Zealand do not necessarily see failure as success, and I think it absolutely can be.
Right, yes. There is that risk-averse nature, especially in the funds management sector?
Yes, there is.
Or historically there has been?
Yeah, I would say there still is,
Yep.
particularly towards exposure to the opportunity of companies failing. And one of the challenges, I think...
It sounds like counterintuitive, doesn't it? The opportunities of companies failing.
Yeah, it is, but we don't know which ones are going to be the winners, and you're just creating a basket of opportunities, and hopefully something comes out of that. But there is a reputational angle, I think, that it's taking a while for institutions in New Zealand to get attuned to.
What do you mean by that? Reputational angle?
So what I mean is they don't want to be associated with having invested in a failing business. And you see it come through even in the media sometimes around specific stories about founders of companies failing, and they don't want to be associated with that. They don't want their name to be associated with that. The way we've had to deal with that is we've split out our funds from the early stage, kind of potential for loss and failure, into a venture capital fund called Emerge, and a later stage where failure is very rare, and failure would mean earning less on the business.
Right.
And that's our growth fund. And we've done that because the KiwiSavers don't want exposure to that possibility of failure. They just want exposure to kind of that lower risk revenue growth style business.
Okay. But also there's lost opportunity there, isn't there? Because what if you actually do get the one and you invest in early that, as you say, hits it out of the park? What is the rate of return that you can see from something like that?
It's massive. And those original Power by Proxy rounds were probably 50 to 100x on our original money in that.
50 to 100 times.
Yeah, and obviously those are the original rounds. You have to invest later.
Yep.
That gets averaged down, and then you've got to account for all the failures as well.
Yeah.
But that, I'm happy to say this, that $25 million Fund 2 was a 5.5 times return on that money, powered by Power by Proxy and powered by Aroa Biosurgery. And
So 2 out of the 14.
Exactly. It's the exact numbers that you hope to hit. And so we do have those proof points that the opportunity exists in New Zealand. And we're just kind of banging on the table, hoping more and more people listen.
A few are listening. Movac has repeated investments from the New Zealand Super Fund and now 2 KiwiSaver funds, Generate and Fisher funds. Let's talk about allocations. I did get Morningstar to do some research, and they say that 1.8% of total assets in KiwiSaver funds is invested in alternative assets like Movac. But Australia is like 20%. That's a massive gap.
That is a massive gap. And if you look at the work that New Zealand Super Fund do in this space, I wouldn't be surprised. In fact, I think their alternative allocation is north of 30%. But that sort of model of, wanting to bear the illiquidity and deal with that to generate outsized returns is something that is thematic through New Zealand Super and those style of
So the
investments.
reward, if they hit it out of the park, is the size of return. Like it's way bigger than your conservative, your balanced, and even your growth or aggressive funds and KiwiSaver funds.
Yep.
Okay. But the flip side is, I think you just called it illiquidity. So that means you just can't get your funds out. You can't be an ATM for these KiwiSaver funds.
No, and that was certainly a concern that was brought up to us, say, in 2016, 2015, when we were raising for Fund 4. That hasn't had the same level of emphasis in the last few years. Part of that scale, if you're looking to invest 10 or 20 million in an alternative asset manager, like a Check and Us would be, and you've got 12 billion under management because you're Fisher funds, or even 13, the liquidity risk isn't there.
Right.
You've also got what's happening with KiwiSaver is people can't really pull their money out, and you've just got inflows every day. And so that real liquidity risk or run on a fund hasn't really eventuated. And even the FMA has become a little bit more relaxed about how they may view some of these more liquid products in KiwiSavers.
Okay. A few years back, I think your founder said that KiwiSaver funds managers were lazy. Didn't he?
He did.
Yep. And that got quite a
in
reaction.
The NZ Herald. It did. Yeah. It had
Is that still the case? I mean, what was the point of what was going on there?
I think he was just trying to rile them up a little bit. And look, it did work to a certain extent. You know, the very first KiwiSaver manager to invest in the venture space was Kiwi Wealth, who are now owned by Fisher. Yep. So I think that comment by Phil absolutely did its job.
Yeah.
But I mean, you have, alongside that rapid growth in the KiwiSaver space, there's been a little bit of a capability gap if you looked, for example, at the teams that New Zealand Super may have in place.
Right, so you're saying that the funds don't have investing teams which have experience or are prepared to get into these alternative asset classes?
That's by and large the case.
Fisher Funds has decided to invest in this investing space. It's putting together its own private equity team. Here's Ashley Gardine again.
We think it's a good time to be doing this. We already have a few allocations to external private equity funds, but if you want to put a lot of money to work in the from a KiwiSaver fund into private companies, then you need to sort of be able to do this yourself and have a bit more control. When you look at the data, there's something like 1,000 companies, 1,000 private companies in New Zealand valued between $20 million and $100 million. So there's a real opportunity there to invest in growing New Zealand businesses, but to do that you need your own team to be able to do the due diligence, do the investment work, and then ultimately oversee, acquire, and then eventually exit those businesses.
Okay, so just so I'm clear, you've already invested in some funds which specialise in startups and emerging companies,
right, yep.
But you're going to do it yourself.
Yep.
Is Fisher Funds going to directly invest in companies?
Yeah, so that's the intention. We already directly actively invest in publicly listed companies, obviously.
Yeah, but private companies.
And this is a different skill set. So we've hired a couple of individuals who have done this previously very successfully, and the intention there would be to set up a fund, which we're in the process of doing at the moment, to acquire either stakes in, say a majority stake in a business with management still in there as well, potentially in some cases the whole business, or in other instances it might just be a minority investment in a growing business that we want to support.
Okay. Is there a risk there that you make a bad bet and that one of the companies that you invest in goes belly up? And that's a lot of volatility. And is the risk then that you have reputational damage and somebody says these guys don't know what they're doing?
Yeah, I think that's always a risk with investing, whether it's public markets or private markets. So we've invested successfully for 25 years in listed companies. Not all of those investments play out well. You hope that the majority of them do over the long term. And it'll be the same with private equity. In the private equity fund, we'll still have broad diversification, but we tend to be even more conservative in those sorts of investments, looking for mature companies that have been around for a long time, have track records of growth, have well-established management teams, and unlike a lot of global private equity firms, we wouldn't be using much debt in this endeavour.
Right, so it's not going to be leveraged.
No, that's right, yeah.
Okay, so it sounds like you're going to be going for the more mature private market rather than a unicorn.
That's it, yeah.
There's one more issue to cover, and that is fees. They are usually a percentage of funds under management. But how do you calculate what a private company is worth as compared to being publicly listed on the stock exchange? Here's Morningstar's Greg Bunkle.
An asset that only values once or twice a year looks artificially less volatile than the underlying asset itself if it was traded on the market. So, there are, and that is some of the arguments against private assets, is they are just the same as listed assets in some ways, except that they are just not as often traded.
And this is the counter-argument from Fisher Funds.
When you allocate to a private equity firm, they'll do valuations of all of their portfolio companies every quarter. So it's not marked to market on a daily basis, but every quarter they'll do a valuation with a set framework, and then annually they'll get the auditors to audit those valuations. So
right.
there's quite a well-established process for doing this globally.
There is there?
Yep.
Yeah, I don't know that people necessarily, or the lay KiwiSaver investor would know about that process. And they can see, with the stock market, if I'm being charged 1.2% or something for funds under management, it's easy to understand. But
yep.
not necessarily when it's a private valuation.
Yeah, I think it's still, in terms of KiwiSaver, the fees would still be charged on the overall pot, the overall KiwiSaver pot. When you're allocating money to external private equity managers, they charge fees, but the fee benchmarks and approaches that they use are well trodden.
So it should be a no-brainer. According to investment bank JP Morgan, private equity is actually less volatile than listed stocks and brings in better returns. But as always, see terms and conditions. It seems the best returns are provided by the top 25% of startup fund managers, so you need to be investing with the top 25 club. Still, is it time KiwiSaver fund managers had an appetite for private equity? If we don't do this as a retirement savings scheme, what are the risks?
Yeah, I think if we don't do it, I think the risk is just potentially lower returns. So we've seen 20, 30 years now of evidence that private equity tends to outperform the share market. Private credit tends to outperform the bond market. So by doing this, if you can do it in a sort of a risk-managed way, you can get a premium over and above public markets. Yeah. And over 20 or 30 years, that really does add up to better retirement savings for Kiwis.
And that wraps up this episode of the NBR Podcast. Links to audio used can be found in the description. Thanks to content producer Joseph Hisayasu and creative director Michael Hickmott. And for early access to new episodes, subscribe at nbr.co.nz. Next episode, media and rugby industry veteran Brent Impey on the blow-up in broadcast TV and delivering aid to Ukraine. I'm Simon Shepherd. We'll catch you then.